Welcome, Facebook followers. We are glad that you're joining us today for our Facebook Live. As you can see, we're changing it up just a bit today. Typically, Tasha is your host, but today you get me, Lisa Piercefield, and I'm going to take you on a virtual credit voyage. And so, with the rising inflation rates and the rising interest rates, we felt that it would be a great time to talk about credit, your financial journey, and what you can do to ensure that you're going to get the best rates possible for you. So, if you're ready, let's begin. I want to welcome you and also would like to give a big thanks out to Ideas 42, who developed the content that we're going to cover today with the support of Capital One. So thank you. All right, so let's talk a little bit about where are we going to go today during our credit voyage. So there are basically 4 steps today that we're going to talk about. The great news is that you have step number 1 that you can check off of your list, which is join the virtual event today on our Facebook Live. We're going to talk about choosing your financial destination and envisioning what that looks like and creating steps to get there. We're also going to cover why your credit matters. Credit's a big deal. Again, as you know, interest rates are rising. And in order to get the best rate for you, you're going to want to have a great credit score. And we want to give you those tips and tools to help you get there. And then we're going to talk about charting your steps. So, what are the steps necessary that you can take to get you where you want to be in your financial journey so you can reach that destination? And quite honestly, that financial journey to your destination doesn't end with today. It goes beyond today, and we're going to help you figure out what those steps look like. All right, so choosing your destination. We know that journeys are tough, right? But the destination has to be worth it. So, what I want you to think about when I'm talking about your destination or your financial destination is really your financial goal. So, where do you see yourself? And try to envision that. Your destination could be, maybe you want to be a homeowner one day. Maybe it's you want to buy a new vehicle. Whatever that destination is, we want you to understand that the stronger your credit is, the quicker and more likely you will be able to get to that destination. So, if you wouldn't mind, if you would entertain me and drop down in the comment section, what is your financial destination and why is it important to you? So, for instance, I'm going to give an example. Let's say that I want to buy a new home soon and I want to make sure that my credit is where it needs to be so that I can get the best deal. Why is that so important to me? Well, it's important for a couple of reasons. It's important, one, because the current neighborhood that I live in is really not the best neighborhood. And so I want to make sure that I'm able to move to a safe neighborhood, but I also want to make sure that I get the best deal so that I can be saving money on interest and I can be putting that interest or that money saved towards my retirement. So you go ahead and drop in that comment section what your destination is. Step 3. Why credit matters. So this is where we're going to spend the majority of our time today, is really talking about credit, why it matters, understanding what a credit report or credit score is, and ways in which you can improve it if that's the situation that you're in. Okay, so the question I get all the time is, okay, really, well, what's a credit score? I like to think about things on simple terms because I'm simple minded. And so basically, you can take a credit score and you can it kind of correlates or could be very similar to back when you were in school and you would get a report card. So if you remember those days, an A was outstanding, a D was not so outstanding. And so that's kind of the same as with a credit score. So basically, a credit score is an algorithm that takes into account many variables of a credit report, and it puts it into a number that makes it easily identifiable to say whether or not you're a good credit risk. So it really measures your credit worthiness. Understand that credit scores can change from day to day, and also that there are over 100 credit scoring models out there. I like to help individuals understand the importance is that it's more about your behavior and how you take care of your credit that will have the impact on your credit score. So rather than focusing on that credit score and only on that score, we would want you to start focusing on the behaviors and the good habits that help improve that credit score. So the reason a good credit score is important is because one, it can help you get access to things that you may not be able to save up money for. So, for instance, if buying a house is your financial destination and that's what you're hoping to accomplish, good credit can help you get there. So, back in the day of my parents and grandparents, where they were able to save money and to buy a house, homes are a little more expensive these days, and it's difficult to amass a large amount of money to think about being able to pay cash for a home. So good credit can help you qualify for a home loan, for a mortgage loan, for higher education. It can help you get credit or establish credit so that you can use that in case of an emergency. And the other thing about a credit score that's super important is that when you have a higher credit score, it gives you access to better interest rates. And a better interest rate means that you're paying less for that borrowed money, which means that gives you more money in your pocket. So that's why it's important, and that's why we want to talk about it today. Credit scores also have a range depending on, there are three major bureaus. So there's Experian, TransUnion, and Equifax. They don't all contain the same information. So your creditors can report to whichever credit reporting agency or repository that they want to. But you may find if you pull a copy of all three of your credit reports that the information contained in one may be contained in all of them. They do have different scores. So your credit score can be anywhere from 300 to 850, depending on, which model you're looking at. And the important thing to remember about credit scores when you are comparing them with the three credit reporting agencies is that you're not comparing apples to apples. So again, Experian has its own scoring model, so that credit score is relevant to Experian, and TransUnion the same way, and Equifax the same way. All right, so let's do a quick check-in here. Has anyone here seen their credit score? So if you have, if you wouldn't mind to just go ahead and drop it in the comment section. And if you have and you're thinking, oh my gosh, what comes to mind when you look at your credit score? So do you have feelings of shame, fear, or do you have feelings of confidence and of opportunities? Okay. So regardless of where you're at, please understand this, that if you have a ways to go on your credit score, that's fine. This is a great place to start. We all have to start somewhere. And if you're in a position where you have a great credit score, that's awesome too. And we want to ensure that you have tips and tools at your fingertips, and that you have the knowledge and resources so that you can keep your credit score where it needs to be so you can still continue to get those great opportunities. So remember, no matter what your score is today, you are in the right place to improve it. All right, so it's important to check your progress. So you can monitor your credit, and you can monitor your credit for free. But a lot of relationships that you may have with credit cards or with banking institutions typically do have tools available for you to monitor your credit. Some of them have simulators that actually take your credit score and the information contained in that credit report, and they let you do a simulation. So maybe you have a collection account and you have a credit card that is delinquent. And so that's affecting your credit score. You can do what if scenarios to show, like, what if I brought this account current? What if I paid off this collection account? And so that simulator will show you how those behaviors and taking those action steps will impact your credit score. So let's talk a little bit about why credit matters. So I have a story to share with you to illustrate the importance of having a good credit score and maintaining a healthy credit. So Mrs. Garcia and Mr. Jones decided that they want to buy a car. And it just so happens to be that they're going to buy the same car, same price. So they both go to their banking institution and they apply for a $10,000 loan and they receive it on a 3-year term. After 3 years, though, Mr. Jones has paid about $3,000 more than Mrs. Garcia. So think about that. Why do you think that Mr. Jones had to pay more money or paid back more money than Mrs. Garcia? What do you think happened there? Go ahead and drop your comments there and let me know what your thoughts are as to why this could happen. All right, so Mr. Jones had a credit score of 420. That qualified him for a 20% interest rate. So on that $10,000 loan, he actually paid back $13,378 over the course of 3 years. Miss Garcia, on the other hand, had a credit score of 720, and that qualified her for a 3.5% interest rate. Same term, 3 years, but she only paid back $10,548. So you can clearly see the difference there, that the importance of working on your credit so that you can improve that credit score. And we're going to talk a bit in just a moment about what makes up that credit score so that you will know, hey, what is it that I need to be doing that's positively impacting it? What I want to make sure that, is illustrated here and that we kind of really get a grip on is that there are situations where we may have to go out and access credit. And maybe our credit is not in, the best place that it could be. So that credit score falls like Mr. Jones has. And quite honestly, with a 420 credit score, Mr. Jones probably really isn't getting a loan in the market today, to be very honest, because that's a low score. But the difference here that I want to illustrate is that he paid back $3,378 for a $10,000 loan because he had a 20% interest rate, which is a pretty significant interest rate. On the other hand, Mrs. Garcia paid back $10,548. So she really only paid back interest of $548 over the course of her 3-year loan, as where Mr. Jones paid back $3,378. And that's a significant difference. And, sometimes we are in positions where, hey, the credit is what it is, and you need a car to get back and forth to work so you can pay your bills. And certainly we understand that. But with planning and setting those financial goals and being accountable or having an accountability partner really can ensure that you stay on track so that if this situation happens that you had to get a loan for a car, that you would be able to get a better interest rate than the 20%, because that really does kind of zap that wealth building when you're paying that type of interest. So anyway, let's talk about the cost of borrowing, because I just mentioned the interest and, understanding that it really can be affected basically by two main factors. So the interest rate and the time to pay off the debt. Now, if you have a higher interest rate and you're paying a longer period of time, it's going to cost you more money to borrow. Okay, so again, I'll say that again. A higher interest rate and a longer length of time to pay off the debt is going to cost you more for borrowing that money. So, an example when I'm talking about length of time is a lot of times consumers are what I call payment buyers. So they decide they want to buy a car and they've looked in their budget and they say, all right, well, I can afford a $300 car payment. So they go out, find this beautiful red sporty car and like, yes, that's the one I want. Well, the price tag might be a little more than you're expecting it to be, right? So when you sit down and you talk with a lender, and maybe you were anticipating, $300 car payment at buying a car for $10,000. You realize you love that car. And so you really have to have it. And you tell the sales guy that, oh, I really love this car, but the car payment is I need to keep my car payment at 300. Or they ask you, so what car payment are you looking for? And you're like, hey, $300. Well, guess what? You could take a $20,000 car and probably make it into a $300 car payment by stretching it out to 72 months. So instead of financing it for 3 years, where it might be a $600 car payment, miraculously, they spread it out for 72 months and voila, they have reduced that car payment to $300. Now, the thing to think about and what you want to look at is really that truth in lending. So how much are you paying back $300 a month for 72 months? And is that car going to be worth anything at the end of 72 months? So you have to be careful. And that's what you get into when interest rates are higher and you spread things out longer. So let's look at it a different way. So ideally, if you have a higher credit score, typically you're going to have a lower interest rate. So what that does is that makes it cheaper for you to borrow. So if you have a good credit score and that gets you a lower interest rate, what that means is potentially it's going to cost you less money to borrow or less interest to borrow that money. Okay, so in the end, it's costing you less. Now, again, same thing. It could be that you have a good credit score, a lower interest rate, but you still spread it out over 72 months. The longer you spread something out, the more you're going to be paying back for borrowing that money. So just remember, higher credit scores can increase the chances that you're going to get credit and that you're going to get it at a competitive rate. We all like a good deal. At least I know I do. Okay, so the ingredients for creating a good credit score. So I mentioned earlier that there are over 100 variables that go into making up your credit score. Like they're different things. So a credit score is a moment in time. You could pull your credit last week and you could pull it today and it could have two different numbers. And the reason for that is all of those variables that are in there. So as I go through here and tell you about, let's look at the 5 major impacts or ingredients, if you will, in making up a credit score, you'll see where that falls into play there. Okay. So first and foremost, payment history. 35% of your credit score is based on your payment history. So that's whether you've paid your bills consistently and you've paid them on time. So that's key. If you're in a position right now that, you've fallen on hard times, I mean, we all know what's happened. We've had COVID and the impacts of that, and then inflation driving up what it's costing us at the grocery store and at the gas station. Sometimes it's tough. We're pinched for pennies. And then as things continue to increase and there's more month than money, something has to go. And sometimes individuals have to make that choice to, pay a bill late. I don't recommend it for many different reasons, but primarily because it's costing you more. Not only is it costing you in your credit score, but you have a late fee involved in that too, typically when you're delinquent in something. So making sure that you're able to pay your payments on time. So if you're currently delinquent, One of your financial goals may be like, I'm going to bring my credit card current within the next 60 days. And then map out a way and action steps of how you're going to do that because it has a 35% impact on your credit score. And I will also tell you that it's way easier to drive that credit score down than it is to increase your credit score. Okay. The second major ingredient is credit utilization. So 30% of your credit score is based on your credit utilization. And the credit utilization is basically a percentage of the available credit that you have, so your credit limit, versus what you have spent or borrowed. Okay, so anytime you're using a credit card, you're spending future income. Basically, you are borrowing money when you have a credit card transaction. So, an example: let's say that I have a credit card that has $1,000 limit. If I am going to stick within this 30% credit utilization ratio, I cannot have a balance on that particular credit card of over $300. So 30% of 1,000 is 300. If you have multiple credit cards, then what you would do is you would take the total credit limit and then you could multiply that by 30%. And that's where you would want to keep your balances below that 30%. Okay, so that's really important, credit utilization. One other thing I just want to mention right here with credit utilization, a lot of times individuals who have experienced maybe barriers with their credit in the past, or they've had credit issues in the past and maybe not a good relationship with maybe a credit card institution or a banking institution, they say, I can't wait till I get that credit card paid off because as soon as I do, I'm closing that out, and they close it out. And what they do is that drops their credit score because they don't have that utilization. They don't have that credit limit to show that utilization ratio. And it has a significant impact on your credit score. So if you are trying to build credit, and we know payment history and credit utilization is key in a credit score, but you are struggling with, I don't want to use that credit card any longer, then guess what? Just don't close it out. Just stick it in a safe in your house. Or I like to say, freeze your assets, put it in a plastic cup of water and stick it in the freezer, and you have frozen assets. So there are more ways to put things in your way or in your path to discourage you from using credit if that's where it's at, and you don't have the behavior yet that you can just be able to not use it when you're out and about. So think about that. All right, the next thing in our ingredient would be the credit history. So the length of time that you have had accounts is crucial. So the longevity, the longer you have had an account open, the better it's going to be for your credit history. So sometimes people have what's called a thin file, meaning that they have they've just opened credit. Maybe they only have one trade line. It wasn't a large credit limit. Maybe it was $500, $1,000, and they've just recently paid on it. In that instance, certainly you would not want to, have a credit barrier and then be like, oh, I'm closing out that card, not using it again because it was your only meet trade line. You're closing it out. So it's important to have established over time a long credit history. So they look at the amount of time that the account has been open, and really then, kind of the most recent action. So sometimes people have a ton of credit cards open and they never use them. Well, that's also not helping your credit score either, because creditors can see inactivity and be like, all right, we're going to close that out for you. So anyway, we encourage you. There's Credit Creed. We encourage you when you're using credit cards. Credit's not bad. Credit gives people the opportunity to do things that they couldn't necessarily save for. So, it's not good credit, bad credit. It's our behaviors and how we handle them. But one of the credit creeds that I have is that you don't charge more on that credit available line of credit or credit card than you're able to pay off in a 30 or 60-day time frame. Because if you can't pay it off in that time frame, one, you have to ask yourself, was it really something that you should have been charging up if you can't pay it off? And then secondly, what happens? I mean, if you can't pay it off in 60 days, What's changed is you're going to pay it off in 90 or 120. And so sometimes that can start a cycle. Okay, let's move on. So 10% of new credit. So whether you've opened new lines of credit, that has an impact. So if, Christmas season is coming up for those who celebrate that holiday, Thanksgiving and Christmas both are upcoming. And I know we get in the festive spirit and it's like, oh my gosh, we're going to go out and, we're going to buy someone this present and that present. And or maybe online these days, really getting online and you get to the checkout and it's like, hey, do you want to save 15% on your total bill today? You're like, oh, yeah, I'm going to do that. And so you sign up for that credit card. Okay. That's a hard inquiry that hits your credit score. And has an impact on it. So you do want to be careful and not just, you really want to think about that and you really want to pace yourself when you're opening up credit because new lines of credit can impact your credit score with those hard inquiries. And then the last is the credit mix. And so a credit mix really refers to the different types of credit you have. So whether it's like a credit card, a line of credit, student loans, auto payment, mortgage, those are different mixes of credit. So that impacts your credit score about 10%. So those are the 5 top ingredients for helping or for what make up your credit score. And so, think about those and think about where you're at. And knowing that payment history and credit utilization are basically 65% of the credit score, that's really where we're going to focus. All right. So, what are the 2 most important factors of a credit score? You can go ahead and drop your comments down there, but I'm going to tell you what they are. So, we did just talk about it. Utilization ratio, excuse me, and also payment history. So, it's important when you're trying to build a strong credit score that, let's say you're one of those individuals with a new credit file. It may take time, a long time for you to be able to actually build a credit score. They're going to look at the amount that you're spending and how are you paying and how long have you had it. So, don't be discouraged if you think, oh, I'm going to run out there, get a credit card today, and I'm going to have a 750 credit score tomorrow, because it doesn't work like that. So how it works is repaying on time consistently and making sure that you stay under that 30% utilization ratio, and also making sure that you keep that oldest active account open. And because, we're talking about that length of time that you need there. So don't be tempted when you're saying, I'm going to close out credit. If, down the road, so you've established credit and we get down the road, and maybe you have 3 or 4 different trade lines and, it's 5 or 7 years. And you're like, I think I'm going to close out credit. I don't care. I'm worried someone's going to use my card. That's at least what we hear at our counseling agency. Make sure it's not the oldest one that you have, right? Because you want to keep that oldest one open and active. All right. So I mentioned debts and paying off debt and helping your credit score. And so one thing that we want to be careful of is that I said using your credit and being able to pay it off in a 30 or 60-day time frame so that we don't get in that debt cycle with credit cards. So the thing to remember is that it can become a barrier and an issue for reaching your financial destination if you have debt that's tied to a high interest rate because it costs you more money and it's going to take you a longer period of time to pay it down. Credit cards is one of those things. If you look at a credit card statement, if you happen to have a credit card that has a balance, pull out that statement, take a look at it, and it's going to say to you on there, if you make the minimum monthly payment of $20, it's going to take you 3 years to pay this off, and you're going to have paid back $500 in interest. Okay, let's elevate that. You have a $10,000 credit card balance at an 18% interest rate, and you're making that minimum monthly payment of, $200, and you can't afford to pay more than that. What you're going to find is that debt's not going down very quickly. And that's how you can start getting in that cycle of debt. So we want to be very careful when you're taking out those trade lines and you're using them, that you're being, that you're being responsible with those. And we understand that there are times that you have to use them in an emergency, but define an emergency. I always used to say an emergency could be, hey, you have a flat tire, you have a dead battery, and you didn't have a personal savings account or an emergency savings account. Okay, you may have to pull out that card and use it, but it certainly isn't that it is, Prime Day on Amazon and you can get 15% off of everything you order, right? That's not an emergency. So in your mind, define what an emergency looks like. But understand that debt can help you strengthen your credit score. So debt's not a bad thing if you're getting it at a reasonable rate and you're paying it off quickly, because quickly and consistently. So you use it, pay it off, use it, pay it off. That can help build your credit score. So that's two different ways debt can impact, either positively or negatively impact your credit score. I mentioned earlier about paying that minimum monthly payment. So here's an illustration. Pretty simple. $2,500 each person's taking out. The interest rate is 18%. So those two things are the same. But look at the minimum monthly payments. So Mr. Lewis, $25 minimum monthly payment. It's going to take him 19 years to pay that off. 19 years. I know it doesn't seem like $2,500, a $25 payment. So remember when I mentioned being a payment buyer, like with that car payment, be careful when you're using credit cards that you're not just saying, oh, how much can I afford a minimum monthly payment, right? Don't go by the minimum monthly payment. Go by, hey, if I'm going to charge this, I'd like to get it paid off in 30 to 60 days. If you look at Mrs. Clark, she is paying it off at a monthly payment of $125. And so that's going to take her 2 years to pay it off. And she's only going to pay $444 in interest. So you can clearly see that Mrs. Clark paid $100 more each month and got hers paid off quicker than Mr. Lewis did, and saved a ton, over $4,400 in interest. And so this is basically, I'm letting you know again, right? She got hers paid off quicker because she paid more than the minimum monthly payment, and that helped reduce the amount of interest. And that interest is what we get charged for borrowing money. And on the opposite, Mrs. Clark was, had to pay a whole lot longer, and it took her 10 times longer to pay that debt off. And we certainly see people in that predicament. But Appraisant has solutions for your financial goals. So we can touch base later on that. All right, step number 4, charting your next steps. So basically what we're going to do here is I'm just going to walk through some strategies that you can use to help strengthen your credit. I'm going to use some examples here. And so as we review these and I walk through these, think about one strategy that you'd most like to pursue. So make sure that it's something that's relevant to you. I may be talking about paying off credit card debt, and you may have something different, right? Credit card debt, maybe you don't have any, and that's a great thing. And so that may not be relevant to you. So just remember, there's pressures out there that people are trying to tell you, hey, this is what your financial journey and destination should be, but make it relevant to you, because what you're going to find is that you're more in tune with it, and it'll more likely happen because it's something that's relevant. Okay. So let's choose a strategy. Let's say, because remember, we're working on credit and wanting to positively impact the credit score. So we could say, pay bills on time, manage your account, start building credit, or maybe getting that utilization ratio for your credit cards under that 30%. Okay, so having a credit history and a credit score is important to accessing financial opportunities. I think we've clearly laid that out for you here, in the webinar. And so without either of those, we can be very limited in reaching our financial goals. Buying a house, as I mentioned earlier, that could be very difficult if we don't have access to credit and we don't have access to affordable credit. So in this strategy, you would work towards building a credit history, maybe starting with a credit score. If you haven't had credit before, sometimes it's difficult to get. So poor credit or bad credit, as people say, so a negative credit rating and no credit rating can look very similar. They're very different because one has to do with how your payment history has been and so forth. The other is just that you haven't been extended credit. So anyway, very similar, but yet very different. So did you know that over 25 million American adults don't have a credit history? So think about it. Like credit's pulled for everything: renting an apartment, getting a car, a cell phone, mortgage, also sometimes for insurance. Okay, so number two, improving payment history. So we mentioned earlier, a single missed payment is a negative on your credit report. And so it can actually impact your credit score up to 100 points. And that's huge because, again, it goes down quicker than it goes up. So with this strategy, you would be working towards paying your bills consistently on time, right? So we're saying, hey, we've identified the problem. Let's identify the solution. If your goal is staying under that 30% of your utilization ratio or credit limit, then the thing that you'll want to do is you want to make sure that you learn tactics to stay under that 30%. So know, first of all, what is the 30% out of your available credit? If it's $1,000 as your credit limit, 300 is what you have to stay under. So you'd be thinking about strategies for maybe you don't take your credit card with you to the grocery store and put groceries on it all the time. Maybe you charge it up to $300 and then you pay it off. And then you charge it up to $300 and you pay it off. And so you continually do that. You're staying under your limit. You're also building a positive payment history. And if it was managing accounts, so having a longer account history, I mentioned a mix of accounts and fewer inquiries, can really have a positive effect on your credit score. And so with this strategy, what you want to work towards is you want to work towards maintaining those old accounts, as I mentioned, so keeping them open and keeping them active. And then if you need to open up new accounts, make sure that you do that with caution, because it's very easy to have 2 and then you have 10. And then that can be tempting. And honestly, I'm not sure that anyone really needs 10 credit cards that are open, but a couple of different ones to, for sometimes rewards. I have a couple different credit cards open because I utilize their rewards points, and they're very different. All right, so have a quick question for you. Love you to drop it in the comment section. Which strategy did you choose? Okay. All right, so here's what we're doing. How do you create steps from your strategy? So being able to really chart those steps, what we're going to do is you're going to review and choose one step that you can take now. And then you want to review and choose a step that you can do in the future. Okay, so it's step by step. They're building blocks to get where we want to go. So I'm just going to use an example here based on your strategy, and you choose a step that you can do right now. So just kind of giving you, an example here. Let's go with paying your bills on time. All right. So 1, to do that, how are you going to pay your bills on time? Well, you probably need to know when it's due. So get out the statement, pull up your phone, take a look at the due date. You know when it's due. Think about when you get paid. Second thing is you could set up a reminder. So you could put it on an electronic calendar. If you're still someone who uses a manual calendar, write it down, put it on a sticky, have a section where you set in your house, and that's where your bills are at. Make a date with your bills, right? So every Sunday night at 6 o'clock after dinner, you're going to set in the corner of your house and you're going to have a date with your bills, and you're going to ensure that they're getting paid on time. And then maybe you set up automatic payments. Okay. So those are things that you can do now. And I'm encouraging you to think about what you can do now and map those out. And in that process, looking for ways to be able to save money. So we just have some tips out here for you. If paying your bills on time is the strategy that you're working on, maybe you don't have enough money, maybe your bills are late. That's why you don't have enough money. They're late. You get a late fee. You owe more money. You know how that goes. Then maybe what you should think about is identifying opportunities in which you could reduce expenses. And I know reductions. Sometimes we think, oh, we can't live without that, but I would bet you probably could. If you're late on a credit card, you get charged $25, $35 of a late fee. That could be money going into your personal savings account. So you can work towards that destination, right? That financial destination that you have, owning a home, buying a new car, your financial education. So little things. Are there subscriptions you can cancel? We always say, compare prices for auto insurance. Do that at least every 2 or 3 years. You would be amazed at what you can save. And shop around. So let's break it down. Step 1, right? So your plan is you want to calculate your total utilization ratio. So this is what you want to do. And you're saying this is what you want to do. And you're going to give it a date and you're going to give it a time so that you know, here's what I'm working towards. Okay, based on your strategy, choose a step that you can do in the future. All right, so I'm going to stick with pay bills on time because that's what we were on. All right, so know the due date, set up automatic payments. And then what I may want to do once I've gotten that done is pay at least the minimum monthly payment each billing cycle, right? Because if I don't, even if I make a payment, but it's not the minimum payment or the required payment, I will be assessed a late fee. So again, that's costing you money that you could be taking and putting towards your financial destination. Something else that we could do is pick a savings step, right? So over here, I just mentioned earlier what we could do for savings, but pick a savings step and do it. Make a date to cancel those subscriptions. See if you can go without subscriptions for a little while. Cut the cord on cable. There's lots of things at apprisen.com, our website, that we have tools and resources, Money Minute blogs that can give you all kinds of ideas on how you can trim your expenses, your living expenses, and get more for your money. All right, so step 2. I'm saying, what am I going to do next? Setting up those automatic payments. Let's talk about your goal. All right. Here's what I want you to be thinking about right now. Whatever, I know I've gone through a ton of information in a short amount of time. And we will want you to list comments and questions that you have because we'll have a financial expert that's going to jump back on later on and they're going to be able to answer those, or you'll be able to reach out to us and we'll give you some more information about that near the end. But let's fast forward and talk about your goal. So it's important to start visualizing what it looks like, right? So maybe it is that bright red, shiny car with those chrome wheels and that leather interior. That's what you've wanted your entire life, right? And so now you have a job and you can work towards that. So think about what does that look like to reach that financial destination. So we know that red car is the financial destination. Visualize it. It's a proven fact that if we visualize and we really engage with it, that we are more likely to reach that goal than not. So yeah, let it get in your headspace there. Okay. So one thing that we do need to think about, and it's not something that we want to think about, but it helps prepare us because we know that even with the best intentions and the best laid out plans and your plan of action and action steps that you are checking off left and right, that life happens. And so there may be obstacles that come about, and we need to be thinking about what do we do or what obstacle could come up as I try my next step. And the reason we want to do that is because we want to be pre-planning. How might we overcome that? So give that a little bit of thought. Take a moment there and think about what obstacles could come up as I try my next step and how am I going to overcome them? So research does show that thinking about overcoming those steps actually help you overcome those steps and reach your goals. So overcoming obstacles can be thinking about one possible challenge to completing these steps in the future. If I face blank, then I will do blank, right? So I'm saving for my new car and I'm sick a day at work and I don't have the same amount of income that week. So I'm not able to put in the $100 a week in the savings account that I'm going to for my bright red car. If I face an income challenge, if I face less net weekly income and I'm not able to contribute $100, then I will contribute $75. Or if I can't contribute to my savings account this week because X happened, then I agree that I will work hard, reduce expenses, and next week I will make a $100 deposit into my account. That's an example. So you'd be thinking about those things that could potentially get in your way. And what are you going to do with that? Or I fell off the wagon, I didn't save this week, but you know what? I'm going to get back up. And next week when my paycheck comes in, I am going to do it. And how am I going to do that? I'm going to set up automated savings. Not going to have to worry about me manually transferring the money to my account. It's automatically going to go there. So let's set reminders. It's so important. Using a reminder to help you stay on track. And it can be anything you want. We live in a world of innovation and technology. And so, you can pick up your phone, you can set a reminder there, you can send yourself a note, you can have something automatically sent to you, an email reminder. You can do it that way. You can write it down on paper. I like to sometimes just incorporate have an accountability partner. So there's sometimes things that I do. And I'm like, hey, here's my goal for this week. And I want you to check in with me. And so can you just give me a little boost about Wednesday and ask me how I'm doing? That works well because for me, just having to be accountable to somebody else. But I also do set reminders. I've set reminders on my watch. Sometimes I write them down. Doesn't matter what method you're doing. The important piece of it is taking that action. So we don't ever want to mistake emotion for action, right? Saying, hey, I am going to do that. Like, well, did you do it? I appreciate so much you tuning in to our Facebook Live today. I know I threw a lot at you and we covered a lot of ground in a little amount of time. We just kind of got the tip of the iceberg there, and we know that you might have questions. So what I'm encouraging you to do at this moment is to just jot down right there in the comment section, maybe some questions that you have regarding anything that we've talked about today. And we'll have one of our team of experts to respond to that. Or if you would like, you can call us and we would be happy to help. So we're going to have our phone number. Our phone number is here in our website. Check out our resources that we have available. And we are so thankful that you joined us. One last thing in parting here is that remember that Uprising has custom solutions for your financial journey. And we're here to help. And so we would love for you to take advantage of the opportunity to meet with a certified counselor and to talk about what your financial destination looks like and let us help you get there. So thank you for joining us, and y'all have a great day.